This is Chapter 9's pre-class lecture, Reporting and Analyzing Long-Lived Assets. After studying this chapter, you should be able to describe how the historical cost principle applies to plant assets. You should be able to explain the concept of depreciation. You should be able to compute periodic depreciation using the straight line method and contrast its expense pattern with those of other methods. You should be able to describe the procedure for revising periodic depreciation. You should be able to explain how to account for the disposal of plant assets and describe methods for evaluating the use of plant assets. Identify the basic issues related to reporting intangible assets and indicate how long-lived assets are reported in the financial statements. In the pre-class lecture, we'll go through learning objectives 1, 2, and 3. Okay, first let's define plant assets. We're not talking about flowers here. We are talking about resources that have a physical substance, which just means they have a definite shape and size. They are used in the operations of a business, and they are not intended for sale to customers. That would be inventory. They are also expected to provide service to the company for a number of years, except for land. So we call this plant assets. We also call this property, plant, and equipment. PP&E is what it's also referred to, plant and equipment, fixed assets. All of these terms are synonymous. If you look at plant assets of some popular companies, you can see the plant assets as a percentage of total assets. Wendy's has a large percentage of PP&E as of total assets. So they have lots of buildings and fryers and countertops and cash registers, all of these PP&E, whereas Microsoft, they don't have very many plant assets. They may have a few things, but they just don't have as much as by way of actual long-term physical assets. Okay, so we've defined what PP&E is, plant assets are, rather. Now let's talk about how to determine the cost of them. Basically, when we're talking about plant assets, we use the historical cost principle that requires that companies record plant assets at cost. So if you're buying a truck, a delivery truck for your pizza company, you would record that on your financial statements at whatever you paid for it. It's historical cost. And that cost consists of expenditures necessary to acquire the asset, buying it from the car dealership or the truck dealership, and any cost to make it ready for its intended use. And so there could be some revenue expenditures that are defined as cost incurred to acquire the asset that are expensed immediately, or there could be some capital expenditures that are cost included in a plant asset account. And so what you need to do is you need to see if any additional expenditures that you need to make on your delivery truck or whatever plant asset you're buying is incurred to make it ready for its intended use. And if it is, you need to record that and include that in the cost of the asset. So like I said, the cost is the cash paid in a transaction or the cash equivalent price paid. And the cash equivalent price paid is the fair value of the asset given up. So if you walk in to try to buy a delivery truck, but you've got an old delivery truck that you are using as kind of a trade-in, so you're not paying cash for the new truck in total. You need to record the cash equivalent price of the fair value of that truck that you're trading in, or the fair value of the asset received, whichever is more clearly determinable. Okay, so the next few slides, we're going to walk through some of the main types of plant assets and talk about how we determine their costs. So for land, the cost to determine land would include all necessary costs incurred in making land ready for its intended use. That would increase or debit the land account. And these costs typically include things like the cash purchase price of the land, any closing costs such as the title and attorney fees, any real estate broker commissions that you have to pay when you're buying the land, and any accrued property taxes and other liens on the land assumed by the purchaser. So let's assume that Hayes Manufacturing Company acquires real estate at a cost of $100,000. So they buy some piece of land for $100,000. The property contains an old warehouse that is razed, which means torn down, at a net cost of $6,000. $7,500 in cost, less $1,500 proceeds from getting money from the salvaged material of that old warehouse. And then additional expenditures are the attorney fees of $1,000 and the real estate broker's commission of $8,000. So what we need to do, we've got a bunch of numbers up here. We need to determine the amount to be reported as the cost of the land. So we've got the cash purchase price that should definitely be recorded as the cost of the land because we include that in the cost of the land. What about the net removal cost of the warehouse? Any cost that to tear down the old warehouse? Well, those costs are definitely incurred to make the land ready for its intended use, and so they would be included. As would attorney fees of $1,000, and so would real estate broker commissions, because those are all included in costs of the land that are needed to make it ready for its intended use. So all of those costs are included, and so when you recorded land on your financial statements in your asset section, you would record it at a value of $115,000. Okay, so we've talked about the cost of land. Now let's talk about another type of plan asset called land improvements. Land improvements includes all expenditures necessary to make the improvements ready for their intended use. So you would include all costs necessary to make the improvements ready for their intended use in the cost of land improvements. I guess I need to cover what land improvements are. Land improvements aren't the actual dirt. That's land. Land improvements include things like driveways and parking lots and fences and landscaping and sprinklers. So we've got land, and then we've got land improvements. And the reason why companies break these out, and you need to break these out, is because when we talk about long-term assets, we need to talk about the fact that these assets depreciate and over their useful lives. Well, land is an asset that actually does not depreciate. It stays on the books at $115,000 for as long as you own it. Land doesn't depreciate, but land improvements do. Driveways wear out, parking lots wear out, sprinklers need to be fixed. And so we break these two categories up because we need to depreciate land improvements. They have limited useful lives. Okay, so we've talked about land, we've talked about land improvements. Let's talk about buildings, another type of plant assets. The cost of buildings would include all costs related directly to purchasing the building or constructing the building. So if you're purchasing the building from somebody else, these costs would include the purchase price, any closing costs like attorney fees, title insurance, and real estate broker commissions. It would also include remodeling and replacing or repairing roofs, floors, wirings, and plumbings. If you're constructing the building, the construction cost would include the contract price of constructing the building plus the payments for architect fees, building permits, excavation costs, and the like. So depending on if you're purchasing the building or constructing the building, your costs would be slightly different. But again, it's all the costs that go into getting the building ready to use in your business. Okay, so we've talked about land. We've talked about land improvements. We've talked about buildings. Now let's talk about equipment. Cost for equipment includes all costs incurred in acquiring the equipment and in preparing it for its use. And costs typically include the cash purchase price, sales taxes if you have to pay tax, freight charges to get that equipment to your building or your facility, any insurance during transit, any expenditures that are required to assemble or install or test the unit if the equipment is some sort of maybe conveyor belt or something that's part of your manufacturing process. It need to be assembled and installed and tested. So an example of this, Leonard Company purchases a delivery truck at a cash price of $22,000. Related expenditures are sales taxes of $1,320, painting and lettering of $500, a motor vehicle license of $80, and a 3-year accident insurance policy of $1,600. So we need to compute the cost of the delivery truck. Let's think about what costs go into the delivery truck to make it ready for its intended use. Not costs related to using it, but costs related to getting it ready for its intended use. So if we talk about the cash price of the car, well, the $22,000 would definitely be included in the cost of the delivery truck. The next, sales taxes of $1,320, we would include that in the cost of the plant asset because you need to pay taxes in order to get that truck so that you can start using it. The painting and the lettering, you need to, if you are in the delivery business and you're delivering goods to your customers, you need to paint your name of your business on the side of the truck. And so you need to do that to get it ready for its intended use so people can see what you're doing. So that would also be included. The other two would actually not be included in the cost of the delivery truck. A motor vehicle license for someone who's going to, drive your car, and an insurance policy. Those are costs that are incurred after you start using the truck. These first three costs are costs to get it ready for its intended use. So this is what would be included on the line item in your long-term asset section. So we figured out for this truck what we would record, but now let's actually record it in our financial statements. If we prepare our journal entry, let me show you what it would look like. We've got equipment. We've got a line item in our long-term asset section on our balance sheet called equipment that totaled $23,820. So we need to increase debit our equipment by $23,000, and then we've got those two expenses that we talked about. We have a license expense of $80 and a prepaid insurance asset actually of $1,600. So all of those we paid for with cash, so we would credit our cash account total for $25,500. One thing when we are talking about long-term assets, oftentimes we have the option to either buy a long-term asset or to lease a long-term asset, like a delivery truck or like a copy machine or something. Buying or leasing is an option, and I know you're familiar with the term leasing, but a lease is a contractual agreement in which the owner of an asset, the lessor, allows another party, the lessee, to use the asset for a period of time at an agreed price. Some advantages of leasing are that it reduces the risk of obsolescence. It keeps the onus of obsolescence on the lessor. Since you don't actually own it, you're just leasing the unit. If it becomes obsolete, well, it's no big deal to you. You can just lease a better one or a one that's not obsolete. Oftentimes with leases, there are little or no down payments. There are shared tax advantages. And for most leasing, assets and liabilities are not reported. Since you don't actually own whatever it is that you're leasing, you don't record it on your financial statements. One exception is in the yellow box on this slide, capital leases. For capital leases, you would actually record the assets and liabilities. You will talk at length about capital leases in your intermediate accounting class. Okay, so we have talked about the different types of long-term assets and how we come up with the value, the historical cost of those long-term assets. Now I want to talk about depreciation. Depreciation is the process of allocating to expense the cost of a plant asset over its useful life in a rational and systematic manner. So it's just it's like what you and I think of depreciation. We buy a car, and over time it wears out. And so if we bought a car that was worth $20,000 when we bought it off the lot, over time it's not going to stay, it's not going to remain to have a value of $20,000. It's going to wear out over time, and that's depreciation. So our assets, our personal assets depreciate. Businesses have assets that depreciate as well. It applies to land improvements, buildings, and equipment. And like I mentioned in an earlier slide, land does not get depreciated. So things are depreciable because of the revenue-producing ability of the asset that will decline over the asset's useful life. So we need to spend some time talking about depreciation and how we calculate depreciation. And just like with inventory, that there were different methods to calculate inventory, FIFO, LIFO, and average cost, there are also different ways to compute depreciation. Regardless of which method we are going to use to depreciate our assets, we need to take three things into consideration. We need to know the cost of the asset, which is we just went through over the last several slides. We need to know the useful life of the asset. How long do we think it's going to be in service? And then what is the salvage value of the asset? And the salvage value is an estimate of the asset's value at the end of its useful life. So basically, with this delivery truck, what do you think you can get for it in parts if you took it to the salvage yard or the junkyard at the end of its useful life? So the cost of it at the beginning of its life, the salvage value at the end of its life, and then how long is its life. Those are the three factors that we need to know when we compute depreciation. So we're going to talk about three different types of depreciation methods in this class. Management of a company selects the method it believes best measures an asset's contribution to revenue over its useful life. You can see that a large majority of U.S. companies use the straight line method, but there are two other methods that we're going to talk about, the declining balance method and the units of activity method as well. And these are the three different types of depreciation methods that we'll go through now. So for each of these methods, we're going to use a delivery truck. And so here's the example. If Bill's Pizza purchases a delivery truck on January 1st, 2012, the total cost of the asset is $13,000. Its expected salvage value at the end of its life is $1,000. And they estimate that its useful life in years is 5 years. And its useful life in miles is 100,000 miles. So we're going to go through and we're going to compute depreciation on this delivery truck using the straight line method, then using units of activity, and then using the declining balance method. So under the straight line method, basically the straight line method expenses the same amount for each year. And so what we need to do is first we need to figure out what its depreciable cost is. Well, we have a $13,000 asset that we think will be worth $1,000 at the end of its life. So we need to depreciate it from $13,000 down to $1,000. We need to depreciate it by $12,000. And we need to do that over a period of 5 years. So if we take its depreciable cost of $12,000 and divide it by 5, that basically means that each year of the 5 years of this truck's life, we will depreciate $2,400. $2,400 in year 1, in year 2, in year 3, in year 4, in year 5. And if we look at a table and go through the different years of its life, you can see that in year 1, we depreciate the asset at a rate of 20% or 1/5 of its life, or $2,400. So its accumulated depreciation is $2,400 after 1 year, and its book value is the $13,000 cost minus $2,400 that we've depreciated thus far. If you look at year 2, 2015, we're going to again calculate its depreciation using that 20% or 1/5 rate since we're depreciating over 5 years. So its annual depreciation expense is $2,400. That builds our accumulated depreciation up to $4,800. And so the total book value of this asset after we've depreciated it for 2 years is $13,000 minus the $4,800 that we've depreciated, or $8,200. And if you move on and go down to the 5th year, you can see that again we are depreciating it by $2,400 in the 5th year, and that the total accumulated depreciation is $12,000. So that the book value at the end of its useful life is equal to its salvage value of $1,000. One thing that we need to note is down at the bottom, the way you would record these depreciation entries into your journal entries is you would record a debit to depreciation expense for $2,400, and then you would credit accumulated depreciation, which is the contra asset against your equipment account, for $2,400 also. One other small nuance to note when we're talking about the straight line method is what if the truck wasn't purchased on January 1st? Realistically, not all assets are bought on January 1st, and so they don't have a full year of depreciation at the very beginning. What if it was purchased on April 1st in the first year? So you'd have a partial year in 2014. So you would just take your annual expense of $2,400 and calculate it over just a 9-month period from April 1st all the way to December 31st. And so the first year's expense would only be $1,800. And so you'd have a kind of a sixth year, if you would, down at the bottom where the last 3 months of the asset's life would kind of spill over into that sixth year, 2019. And so your expense for that year would be $600. You're still depreciating the asset by $12,000 in total. So your accumulated depreciation would be $12,000 in total. But you're just breaking the first year up since you didn't purchase it on January the 1st. Okay, so we've talked about the straight line method. Now let's go through the other two methods. The first is the declining balance method, and it's an accelerated method that decreases the annual depreciation expense over the asset's useful life. The declining balance method is usually done in a double manner. So the double declining balance rate is just double the straight line rate that we used earlier. And it's always applied to the book value, not the depreciable cost. And I'll show you that in the next slide. So if we go through the double declining balance method, let me show you how to calculate this. When we were talking about the straight line method, we came up with a 20% rate for the straight line method because every year we depreciate 1/5 of the asset's life because it had a 5-year life, so 1/5 or 20%. Well, in the double declining balance method, what we do is we actually just multiply that straight line rate by 2 to come up with a 40% double declining balance rate. We take the book value, the book value of the asset at the time instead of the depreciable cost and multiply it by our double declining balance rate to get to our annual expense. So our annual expense for the first year would be the $13,000 book value, historical cost, times your 40% rate. So your annual expense in year 1 is $5,200, which if you remember, we were depreciating the straight line rate. Under the straight line rate, our annual expense was $2,400. So this is an accelerated method that expenses more on the front years of the asset's useful life. So the accumulated depreciation is $5,200 since it's just in year 1, and the book value is $13,000 minus the depreciation in that year of $5,200. So the book value is $7,800. And then in year 2, you would just take that book value of $7,800 and multiply it by your double declining balance rate of 40%. And so the expense in year 2, $3,120, increasing your accumulated depreciation up to $8,320 and reducing your book value down to $4,680. And if you go down and calculate all of that, you would get down to an annual expense in year 5, 2018 of $685, and that gets you to a total accumulated depreciation of $12,000 so that your book value at the end of its useful life is $1,000, which is equal to its salvage value. You'll note that the journal entry to record the depreciation expense each year is still a debit to depreciation expense and a credit to accumulated depreciation. Just like it was in the straight line rate. The only thing that's different is each year the numbers would change. So in year 1, the 2014 entry would be a debit to depreciation expense for $5,200 and a credit to accumulated depreciation for $5,200. Okay, so we've talked about the straight line rate. We've talked about the double declining balance rate. Now let's talk about the units of activity method. So the units of activity method is a method where companies estimate the total units of activity to calculate depreciation costs per unit. And the expense varies based on the units of activity. So if you think about a truck naturally wears out as you use it. So in years that you drive the truck a lot, you may want to depreciate it more. So this units of activity method kind of matches the depreciation expense that you record on your financial statements with the actual usage of that asset. And we calculate this. We're back to using the depreciable cost. which is just that cost of $13,000 less the salvage value. So we've got the depreciable cost of $12,000 for this truck, and this time we want to divide it by the total units of activity. Bill thinks that he can use this delivery truck for 100,000 miles, and so every mile that he drives, we want to record a depreciation of 12 cents per mile. So in a year, for example, that he drives the truck 15,000 miles, well, if you use that unit cost of 12 cents, he will depreciate in that year $1,800. So on this slide, you can see that under the units of activity method, your annual expense is different based on the number of miles that the car was driven. This says hours used, but it should be miles driven. So in 2014, he drove it 15,000 miles, and he applies that 12 cent per mile depreciation to the 15,000, so that the annual expense in year one is $1,800. In year two, he drove it 30,000 miles, so he drove it twice as much. So you would think that the annual expense should be twice as much, and in fact it is. If you use the 12 cent per mile depreciation, you would actually record an expense for that year of $3,600, building up the accumulated depreciation to $5,400. And you go on, and if you go through all 5 years, you will note the total accumulated depreciation at the end of its 5-year useful life, or 100,000 mile useful life, is $12,000, and its remaining book value is equal to the salvage value of $1,000. And I'll point out one more time, regardless of what method you use, the debits and credits are still the same. It's just the value is different. So you would record a debit to depreciation expense, a credit to accumulated depreciation each year. In year one in 2014, the value would be $1,800. And the last slide just summarizes the 3 different types of depreciation methods. You can see that the straight line method is depreciating the asset at $2,400 each year to get to a total of $12,000, and that's why it's got a straight red line on this little chart. The declining balance method is kind of all, it starts with a lot of depreciation and then it tapers off as the years go by because it's an accelerated method. And then the units of activity method is based on its activity. So it varies with the number of miles that this car was driven. So the green line is kind of jagged because some years it was driven little, some years it was driven a lot. Regardless, you can see 3 red numbers up there, 12,000, 12,000, 12,000. Regardless of the method used, they depreciated the asset down to its salvage value. So each method comes to the same end result. And each method is acceptable because each recognizes the decline in service potential of the asset in some sort of rational and systematic manner.